Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We've been coming to you live from Philadelphia at Nasdaq and Villanova's School of Business ETF Synapse, where we've been focusing on research, collaboration, and academia in the ETF space. Joining me for the segment of Ed Coughlin. He's AVP with Trading Services over at Nasdaq. Ed, it's great to see you and thank you for joining me. This is interesting. You're going to dispel some of the myths around short selling in ETFs. It has a negative connotation, but it doesn't have to.
Yeah, so I think traders and investors themselves often think of a common stock, and because ETFs trade like common stocks, there's often heavy short sellings associated with a negative aspect to a stock. There's people betting that that stock is going lower. But in the ETF world, with the arbitrage mechanisms that take place, the market makers are actually going short against buyers, but using the arbitrage process promotes liquidity for ETFs. So while you might see on the screen displayed liquidity of smaller size and less liquid instruments, the arbitrage process, which allows market makers to go short, they make short the ETF and then buy the underlying asset, it actually promotes liquidity in these products.
It sounds like it could also be a risk management tool.
Definitely.
Right.
So a market maker, for example, if they're just long or short common stock, that's really an asset or a liability that's on their books, versus an ETF market maker that would be short an ETF and long the underlying. At that point, that's kind of a locked-in arbitrage. So their gross position may be something, but their risk position is far different than just being long or short a common stock.
All right, let's play some inside baseball. You are about to go sit on your panel. What are some of the topics that you guys are going to discuss?
So the professor, and I think it's probably it's knowledge among traders about how they utilize shorts, and they certainly understand that mechanism. But what the academic community brings is a rigor and academic understanding of what that short process is, and it's helpful to educate more people that just because ETFs may have a large short outstanding, that's not necessarily a negative thing for that product. In fact, it's a very good thing for that product that there's extra liquidity in that product or available liquidity.
All right, well, thank you so much for joining us at Synapse today.
Sure.
And thank you for joining me throughout the day from Philadelphia. I'm Jill Malandrino, global markets reporter.